Well, central bank independence and trade will be front and center at the IMF and World Bank spring meetings kicking off in Washington as global economic and finance chiefs grapple with the worst global trade crisis in nearly a century. Joining us now to discuss the global economic outlook, we've got Kevin Khang. He is a senior international economist and head of Vanguard's global economic research team that develops its long-term and cyclical economic outlooks. Kevin, great to speak with you this morning. Talk to me about where things stand today with your outlook on the economy if we do continue to see this pressure on the Fed chair potentially lead to some sort of termination.
Yeah, thanks for having me. Good morning to you. So that's a really interesting question, and I think our approach is that we take one step at a time at this point, and we take those cues from the series of tariff developments that we've seen thus far. The Fed chair, I think, made his commitment to the dual mandate very clear. And I personally thought that he couldn't have made it clearer last week at the Economic Club of Chicago. Mm-hmm. So our view remains that the dual mandate that he is committed to and he articulated really remains the sole goal and job of the Fed. And the balance of the economic situation is such that we are about to see, there's a very high likelihood that we are about to see price increases. And unlike the 2018-19 tariff situation, when most of the tariff was placed on China, the current situation is such that the tariffs are happening really all at the same time across all kinds of goods, not just intermediate, but final goods with effectively most of our trading partners. And that is a situation that really is different from 2018-19. So the inflationary pressure will be tremendous going forward, especially into the second quarter. And in the face of that, we just have to remember what it was like in the 1970s, where we had a very severe adverse supply shocks that caused the great inflation. And the lessons from that period, where when the Fed vacillated between the price stability and full employment, that decade did not end well from the full employment and economic growth standpoint, and also its implications for the financial markets.
Yeah.
So that remains our view.
Yeah, and Kevin, in just about a minute here, obviously the stagnationary period in the 70s leading to a recession. What is your base case for the likelihood that high inflation mixed with lower growth could lead to a recession this time around?
Our view currently, again, we're taking one step at a time, but our view currently is that we're going to see a significantly softer economic growth this year. And our forecast for now is it's going to be somewhere between 0.5 and 1%. Roughly 0.75% growth in the U.S. But again, the variance around our forecast is unusually large, and we're in the state what we would call dancing with recession. So recession may not be our baseline, but we're very close to that in the current state.
And Kevin, my guest host Ann Barry has a question for you as well. Ann.
Kevin, talk to us about what your thoughts are on the weakening of the dollar that we've been seeing in recent weeks. Where does that lead us in the near term?
In the near term, so we would put that, there has been a lot of chatter about, what does that mean? The disconnect between rising treasury yields and the weakening dollar. The current thinking is that that at the minimum reminds all of us that the world is watching whether U.S. is going to continue its role as a provider of reserve currency and provider of stability. Really in times of crises and instability. And to the extent that the U.S. is indicating some sort of a regime shift, what that regime is going to be like. So in the long term, and we're not anticipating the role of reserve currency of U.S. dollar is replaceable. That's a given. The entire international global trade and finance system runs in U.S. dollar. So in the long term, that is our view. That said, in the short term, we're seeing pressures, and we're certainly seeing question marks coming from just the market's reactions. And on the margin, that certainly could put further downward pressure on U.S. dollars.
And talk to me, too, about where you see the most growth globally, Kevin? Because investors are seeking safety outside of the U.S. right now, and I think they may want to follow countries that have stimulus and potential growth opportunities moving forward. So in your final 30 seconds with us, which of those countries abroad do you think have the most growth potential this year?
Emerging markets actually, interestingly, have come out, more in balance, and they actually have done a better job taming inflation ahead of the curve, I would argue, than a lot of other developed economies. So they're actually entering into this phase in a better shape than you otherwise would have expected. That said, if this growth scare or concern about recession turns into something greater and just darker, gloomier, then that obviously has global implications. So I don't know if I necessarily have an optimistic answer to that question.